now it's time for critical thinking. And what do you have?
I want to talk about correlation and how we can use it to understand how either stock prices move together or move apart, and how other asset prices move either together or apart. Often I use the analogy that the economy is the ocean or the bay, and individual stocks are the boats, and when the ocean's going up and down, all the boats go up or down, but obviously there's waves, right? So sometimes the boats go together and sometimes they don't. Currently, in the last month or so, they've moved in very systematic patterns.
Yes, they have.
So in correlation, here's a picture that will help you understand what correlation actually is. So I'm going to draw a graph, and it's a four-dimensional graph. Positive here, and this is negative, and this is positive, and this is negative, so this would be 0. And so let's just put gold at the top, the gold price, and let's put stocks, either the S&P 500 or the Dow, doesn't really matter, along the lines. So if we were going to plot this every day on the change in price, we would look for a pattern over time. So on day one, let's say, what would be a good example here? Let's say gold went up, but stocks went down. So gold went up, but stocks went down. Does that make sense?
Okay.
Day two, gold went up a little bit more, stocks went down a little bit more, maybe a little bit less, a little bit more. Then some days stocks go up and gold goes down. Stocks go up, gold goes down. So you get this pattern. So you can see that they're moving, but they're moving opposite of each other. When gold goes up, stocks go down, right? So that's a correlation. So in statistics, what you would do is you would do mathematically, you'd calculate a line that would be the equivalent of, they call it the line of best fit, but essentially it shows you graphically, in a number sense, it shows you what this shows you graphically, that when gold goes up, stocks go down. And the other ways, when stocks go up, gold goes down. Does that make sense?
Yes, it does.
Okay, so in fact, recently, stocks and gold were moving in a very similar correlation to this, weren't they?
Yes, they were. And this is from the Wall Street Journal, and it said the 30-day average correlation between gold and Standard & Poor's 500 stock index last month hit minus 0.903 on a scale in which -1 represents perfect inverse relationship. This was the strongest inverse relationship since July of 2008.
Which was another panic time.
Yep. So almost exactly when stocks went down, gold went up, and vice versa.
So when they say an inverse correlation, it means that they're moving exactly opposite of each other. So if one goes up one point, the other one goes down 1 point. So they're moving exactly opposite, right? So that's a perfect correlation, is they move exactly in the same amount. So if you go up 1, you go over 1. That's a perfect line. Well, you know, they were a little off, but they're pretty close at 0.9.
Very close,
that's
very
right.
close. So it's the panic trade.
Absolutely.
It's the fear trade.
That's right. Yeah. So that's correlation. Now, that's inverse correlation. Correlation would be exactly opposite. So when gold goes up, stocks go up. And that would look like this, right? You'd have all these different days where stocks both went down, both went up. This would be a perfect correlation, not an inversely perfect correlation. So this would be 1.0, this would be negative 1.0, and in somewhere in between, you get something that's uncorrelated. And what's uncorrelated look like? It looks like a bunch of random dots that has no line,
no pattern whatsoever.
No pattern whatsoever. Sometimes it goes up together, sometimes it doesn't. So that's uncorrelated. And we like uncorrelated or inversely correlated over perfectly correlated, because if we have perfectly correlated, buying two of the same thing means that they're all going to move up together and down together, so we're not diversified. And remember I told you put a little bit of money in all those different boats. Well, if they go up and down together, we're not diversified, right? So we want them to move opposite each other, but all in the same direction, positive. So this is correlation. Now there's a caveat to this. Simply because you can correlate two pieces of information, because you can do this with anything, not gold or stocks. You can do it with the time your alarm clock goes off to the time the sun comes up.
Okay.
Okay, so if you plotted the
they
time...
They seem to be perfectly correlated.
They're pretty closely correlated, right? I mean, well, it depends on what time you get up. But the difference in time between your alarm clock and so on is pretty close every day, right? So if you turn your alarm clock and change it to, say, noon,
Okay.
Well, does that mean that there's a correlation between your alarm clock and the sun anymore?
No.
No, right? So what that brings up is the problem of causality. Simply because you can plot a graph with the data and the data is correct doesn't mean that there's a relationship between the two variables. In this case, it makes sense that when stocks go up, gold goes down because people were fearful, so they put their money into gold. When they become less fearful, they put their money back into stocks. So that kind of makes sense.
Yes.
But if you think about your alarm clock and what time the sun goes up, you could plot the same thing. It would look great. But if you change the time on your alarm clock, it doesn't have any impact on the sun. Nor does what time the sun comes up have on the alarm clock. So you could look every day and go, well, why didn't the alarm clock change if the sun changed, right?
You could.
So that's called causality. So just because there's a correlation does not mean it's causal or has causality. So, diversifying is one thing, but wondering why they move opposite is also an issue. So don't get too interested in the statistics. You still have to be thinking, and that's very important to be thinking here, because otherwise, in the Super Bowl, they have correlations between who wins the Super Bowl and which party's in office or which party's the president.
They do, don't they?
Oh, they do. Oh, absolutely. So you can tell who's going to win the Super Bowl by who's the president. Well, they have nothing to do with each other. Oh, but it's a correlation. Yeah, but there's no causality. There's no causality. It doesn't matter who's in the White House, what the team does. It just happened to turn out that way over the last 40 Super Bowls.
And your takeaway
my takeaway is, if something happens at the same time something else happens, there might be a correlation. But just because something happens to correlate doesn't mean that the correlation has causality. So you have to think about it and not just accept the fact that there's statistics involved.